mini quiz 2. Another second quiz to check the understanding of this session. First, a calculator was purchased for 1200. It is expected to have a life of 3 years. However, the account charges 100% depreciation on the same. This is due to the application of A. Consistency concept, B. Conservatism concept, C. Materiality concept, and D. Matching concept. The calculator was purchased and expected to have a life of 3 years. So if an asset is purchased, it's supposed to have a life of 3 years. Usually, we would spread the cost of the calculator over a period of 3 years. However, the amount is too small, and therefore, because of the materiality concept, the accountant would charge 100% depreciation on the same. The concept here followed is the materiality concept. Next, when machinery is sold for cash, total assets, A, total assets will increase, B, total assets will decrease, C, there will be no change in assets, and D, none of the above. Correct answer should be C, there will be no change in assets because machinery goes out, asset comes down, but cash comes in, therefore asset goes up. So machinery goes out, cash comes in, no change in assets. Correct answer C. Next, the accounting equation is based on A. Conservatism concept, B. Going concern concept, C. Accrual concept, and D. Dual aspect concept. Accounting equation is based on dual aspect concept. Dual aspect, two sides. Each transaction has two sides. So the correct answer is D. Next, providing for all possible losses is due to the A. Conservatism concept, B. Going concern concept, C. Accrual concept, and D. Dual aspect concept. Providing for all possible losses is due to the conservatism concept. A should be the correct answer. Next, 3 primary qualitative characteristics of financial statements are A. Materiality, neutrality, faithful representation, B. Materiality, neutrality, and prudence, C. Understandability, relevance, and completeness, D. Understandability, reliability, and comparability. Answer should be D. Understandability, reliability, and comparability. Make this you are really competent, maybe easier to remember. Competent and comparability. Understandability, relevance, reliability, and comparability. So in this case, the answer should be D. Next, XYZ Enterprises follows the written down value method of depreciating machinery year after year. So that means one policy is being followed year after year due to A. Comparability, B. Convenience, C. Consistency, and D. All of the above. It is followed due to consistency. Option C, consistency. As a result of that, it becomes comparable. It is probably convenient, but it is done following the year after year. It's done due to the concept of consistency. Human resources cannot be shown in the financial statements due to A. Going concern concept, B. Conservatism concept, C. Materiality concept, and D. Money measurement concept. Human resources cannot be shown in the financial statements because it cannot be measured in monetary terms. So, D should be the correct answer. Option D. Matching concept is based on revenue less dash is equal to profit. Revenue less liability is equal to profit. B, revenue less expense profit. C, revenue less asset profit. Or D, none of the above. Correct answer should be revenue less expense. Next, payment of interest on capital by a firm to its owner is an application of payment of interest on capital to its owner. A, going concern. B, money measurement. C, accrual. And D, entity concept. Business pays interest to its owner due to the entity concept. D. If nothing is written in the financial statements about the three fundamental assumptions, then it could be presumed that they have not been followed. B, they have been followed. C, they have been followed to some extent. And D, none of the above. Fundamental accounting assumptions. The three fundamental accounting assumptions were going concern, consistency, and accrual. So what does it mean? If nothing is written about them, then it means that they have been followed. They must be followed. If they are not followed, you are supposed to disclose them. Therefore, the correct answer should be B. Next, window dressing of accounts means presenting accounts in a beautiful manner. B, showing more losses to avoid income tax. C, showing more profits to attract investment. And D, all of the above. Window dressing actually refers to showing more profits to attract investment. Omission of paise and showing the round figures in financial statements is based on A, conservatism concept, B, consistency concept, C, materiality concept, and D, realization concept. Financial statements are now largely shown in thousands of rupees or crores of rupees for companies. This is largely because of the materiality concept. Paise can be omitted. Next, fixed and current assets are categorized as per the concept of A, separate entity, B, going concern entity, C, consistency, and D, time period. Fixed and current assets, non-current and current assets are categorized as per the concept of because of going concern. So if it's going to be used for more than a year, then it is non-current. And if it is going to be used within the year, it is current. So the assumption that there will be more than 1 year is a going concern concept. So fixed and current assets are categorized as per the concept of going concern. According to which concept the owner of an enterprise pays the interest on drawings? We've already done interest on capital. Interest on drawings, the concept of A, accrual, B, conservative, C, entity, and D, dual aspect concept. Obviously it is entity concept. C, entity concept. Next, A purchased a car for 5 lakh, making a down payment of rupees 1 lakh and signing a 4 lakh bill payable due in 60 days. As a result of this transaction, A, assets increased by 5 lakh. B, liabilities increased by 4 lakh. C, total assets increased by 4 lakh. D, total assets increased by 4 lakh with corresponding increase in liabilities by 4 lakh. Which is the correct option? First says total assets increased by 5 lakh, which is not true because though the assets of 5 lakh have come in, there has been a down payment of 1 lakh. Your assets have actually increased by only 4 lakh. So this is not correct. Signing a 4 lakh bill payable due in 60 days. Total liabilities, yes, total liabilities have increased by 4 lakh. This is partially correct. Total assets have increased by 4 lakh. That is also partially correct, because total assets, car has come in for 5 lakh, increased by 5 lakh, but down payment, therefore cash has gone out by 1 lakh. Down payment means an immediate payment. The balance payment is made later. And D, total assets increased by 4 lakh, true, with corresponding increase in liabilities by 4 lakh. This is correct. Option D is the correct option. Next, consider the following data pertaining to Alpha Limited. Cost of machinery 10 lakh, purchased on 1st April. Installation charges 1 lakh. Market value 12 lakh. While finalizing the annual accounts, if the company values the machinery at rupees 12 lakh, which of the following concepts is violated by Alpha Limited? A, cost, B, matching, C, accrual, and D, periodicity. How would you value it? The cost of the machinery is 10 lakh plus 1 lakh. It should be valued at 11 lakh because assets are valued at cost. Matching does not come into the picture. Accrual, no. Periodicity, no. Therefore, the correct answer should be the cost concept. You do not value machinery at the market value. Correct answer, A, cost. Next, capital on 1/4 year beginning 90,000. Capital introduced 25,000. Drawings made 35,000. Capital as on 31/3 year end 1,25,000. What is the amount of profit added to capital? 50,000, B 60,000, C 75,000, and D 45,000. Amount of profit. Actually, if you start with a profit of 1 lakh, I'm ignoring this example, 1 lakh, and you make a profit of 50,000, this 50,000 also belongs to the proprietor, so your closing capital becomes 1,50,000. So closing capital minus opening capital usually is profit, unless you have brought in additional capital or withdrawn additional capital. That is, or withdrawn in the form of drawings. So we could say that profit is equal to closing capital minus opening capital. But if you've already withdrawn, then the closing capital would have come down. So let's add back the drawings. At the same time, if this closing capital does not consist of profit, but it consists of additional capital brought in, let's remove that too. Additional capital. So what is profit? Profit in this case would be, closing capital is 1,25,000. Drawings is 35,000. We add that. Capital introduced is 25,000. So subtract that. And opening capital is 90,000. Therefore, answer is 45,000. Correct answer should be 45,000 is the amount of profit. Amount of profit. Next. Ram starts business with 90,000 and then buys goods from Shyam on credit for 23,000. The accounting equation based on assets equal to capital plus liabilities will be A. 1,13,000 is equal to 90 plus 23,000. B. 1,13,000 is equal to 1,13 plus 0. C. 90 is equal to 67,000 plus 23,000. D. 67,000 is equal to 90,000 minus 23,000. Ram starts business with capital of 90,000. He buys goods from Shyam on credit for 23,000. So, what would it be? There is a business of 90,000. There's a capital of 90. Creditor Shyam for 23. Therefore, the total assets will be cash of 90 plus the goods of 23. Therefore, looks like the first equation A is correct. Next, Ram purchased a car for rupees 10,000 and paid 3,000 as cash, and balance amount will be paid in 3 equal installments. Due to this, total assets increased by 10,000, total liabilities increased by 3,000, assets will increase by 7,000, corresponding increase in liabilities 7,000, and D, both total liabilities increase by 3,000 and assets increase by 7,000 with corresponding increase in liability by 7,000. So assets have actually increased by 7,000 and liabilities have increased by 7,000. C seems to be the correct answer. Assets have increased, 10,000 comes in, 3,000 goes out. Assets have increased by 3,000. There is a liability for the car which is to be paid. Liability has increased by 7,000. Option C should be the correct answer. An asset was purchased for 6,60,000. Cash was paid 1,20,000 and for the balance a bill was drawn for 60 days. What will be the effect on fixed assets? Answer should be 6,60,000 increase in the fixed asset. Assuming this is a fixed asset being purchased, 6,60,000. Cash was paid was 1,20,000. Cash is not a fixed asset. It is called a current asset. Fixed asset is a non-current asset. Therefore, the effect will be 6,60,000. Next, what is the effect on the net assets if cash is received from debtors for debtors of 50,000? What is the effect on net assets if cash is received from debtors 50,000? A increase, B decrease, C no change, and D none of these. Cash is received from debtors, cash asset goes up, debtors asset comes down, therefore there is no change in assets. No change in assets. Next. As per the basic accounting equation, assets equal to capital plus liability, which of the following equation will be true if Ram starts a business with 5,50,000 and then buys goods worth rupees 1,50,000 from Madan on credit? A. 7 lakh, that is assets, is equal to 5,50,000 capital and 1,50,000 liability. Or B. 7 lakh asset equal to 6,50,000 capital and 50,000 liability. Or C. 5,50,000 asset, 5 lakh capital and 50,000 liabilities. And D. Assets 5,50,000, capital 7 lakh, liabilities 1,50,000. So what has happened as per the thing, if Ram starts a business, so 5,50,000 is the capital and then buys goods worth 1,50,000 on credit. So 5,50,000 capital, 1,50,000 credit seems to be okay. And what was the assets? Assets would be capital 5,50,000, cash would have come in, goods of 1,50,000, 7 lakh. So option A seems to be the correct option.